Hey everybody, how are you? Hope it's going well with your business planning, your operations plans are coming together. I'd like to introduce Brad Williams, who I've had the pleasure of working with a few times now. And Brad's currently the CFO for a local tech company, but he also has been actively involved in preparing business plans, due diligence, and managing transactions, the sale of companies. And so fortunate to have him here. Welcome, Brad.
Thanks, Colin.
So today, what we're going to do is we're just going to have a conversation, Brad and I, about the building of the financial plan. So we'll start by talking about source of funds and also use of funds. And so, Brad, maybe to kick it off, what are some things you think when you're looking at a plan, when somebody's got written out a source of funds and where they're accessing capital and also how they plan to deploy that capital? What are some of the sort of sanity checks that somebody could do in the first place?
I think source and use of funds becomes this holy grail that people look at sometimes as this table, and it gets a life of its own. When I think you really have to look at the realities behind, what, is possible. Like it's easy enough to sit and put something out there and say, I'm going to raise equity capital and not really think through kind of, what that might entail. That's on, I don't know. Sorry.
Okay. So if like my sort of take on source of funds is usually, and I was going to say like what I find oftentimes is people don't get a sanity check. So one of the concerns I have is with source of funds is people say, oh, I'm going to get 500 grand from my grandmother or something. And it kind of brings into question the validity of it. And so one idea or recommendation I always make with source of funds is actually talk to a bank or a business loan officer just to qualify what your ask is or what you think you're doing. And there's debt and equity, but let's talk about use of funds just briefly, because I think that's the other area that source of funds can be all over the map, from bank loans to venture capital.
But actually on your point, now that I'm just kind of synced up with what you're thinking, I think source of funds, people, and I've been guilty of this right in the past, right when I did my degree originally too, you sit there and you're like, I need $500,000, I'm going to spend it over 2 years. I think the sanity check you need is to talk to somebody else that isn't drinking the Kool-Aid and can say to you, maybe you start by raising $25,000 and you prove some really small hypothesis, so like it's from that side of the things on the source side. I think, getting the sanity check, having somebody say to you, no, it's not reasonable to go out there and raise $5 million for something right away. Maybe you should break it down into smaller chunks. Investors, in my experience, always, they want to de-risk things, right? So if you can approach, writing a business plan where you can break it down into smaller chunks, that's probably the biggest thing that I take on that source side. Never mind the mix that we're talking about earlier in terms of debt versus equity, but I think the big takeaway for me is helping people understand, no, you're not just going to get that $500,000 check. Maybe it's like 25,000 and then 50 and whatever.
Totally. So, okay, so we've covered source and use of funds, and my only kind of one more comment on that would be that, so we've talked about sanity check, but also I think Brad's point about staging your funding, staging both your source of funds but your use of funds in such a fashion that it looks like you're building over time and with momentum, rather than trying to get all your money up front against just an idea or a business plan. Proof of concepts, market viability testing, all things that qualify you for more capital.
Yeah, and so when I've seen use of funds, say when I've been a CFO of a public company, typically you put out like a memorandum, like a prospectus or something, and you have this small little table. It's got source of funds, debt or equity. Use of funds is like wages and marketing and sales. I think I'd also say don't get too trapped into this tiny little table and just think that that's gospel and perfect. In actual fact, I really think you need to be able to drill into the details behind it, and we're probably gonna have a longer conversation later about, being able to break that down, like we talked about, into stages, number one, and then activities more granularly. It's not just sales and marketing, $100,000.
Right.
Like somewhere in the background, you need to have some ideas and hypothesis. I'm going to do this, and I'm not just going to merely spend it till it's gone. I want to, test it, do something and, spend $5,000 and do a trade show. Do I get a good result? No, yes, right? So that to me, maybe it's a little more detailed than that.
No, I think that makes sense. Okay, so let's talk assumptions.
Yep.
So my experience is, which is you have a lot more familiarity with that, but we, in all kind of what I'll call, plans for some kind of prospective business, there are assumptions that need to be made. Any general tips kind of on assumptions?
I think, yeah. So when I build a model for a business, whether it's startup or a growth company, you know, assumptions are obviously key because they're assumptions. But I think that the trick to using them wisely is to avoid making gross assumptions, right? Like I'm going to sell, $100,000 in revenue in this month or quarter, and I'm going to spend just $10,000 in expenses. Okay, that's an assumption, but it doesn't do you a whole lot of good, right? I mean, to me, the assumptions need to break down into the activities that you're going to do. So if we're talking specifically to sales, it might be, oh, I know that I'm doing a web business and I pay $10 per lead. And a lead, I convert 1 in 10 of those to a customer. Building out your assumptions at that activity level is probably the single most important thing to do. Yeah, it makes your spreadsheet more complicated and it's harder. Maybe you like to make it simpler, but I can't tell you the number of times I sat down with businesses, whether as a mentor, as a CFO or whatever, and had people go, wow, you really took that time to understand this, and it creates insights into your business. You start to realize a cause and effect relationship. Back to my lead example, maybe you realize in order to get to your $1 million in sales, you need 100 million leads, in something, and you're like, wow, that's not reasonable. So I think really driving into the details, on every area makes sense. And we're talking sales and marketing there. You can do the same thing on operations, your direct costs, if you're hosting on AWS, whatever it is.
Okay, so I think the point, what I want to keep making sure that we, my read on that would be that the drill down on those assumptions and the granularity is key, and the validity of those things. Because I find this is about credibility, and when you're using assumptions, I think to Brad's point, what I would say is that the more detail there is in your assumptions, the more likely it is that people will feel like they're somewhat valid. If you have these gross assumptions, as Brad said, the challenge is that it's easy to take them apart and say, where's the data behind this? Yes, it's a bunch of work to kind of qualify on a kind of what I'll call, a one customer basis, but at the same time, the credibility of your model is somewhat dependent on it. So, okay, let's move on because we're cooking with gas. The next thing we're going to talk about is pro formas. And once again, everybody has to kind of cook up a balance sheet and an income statement and a cash flow projection. My experience tells me in a new business, the thing that I like to see personally when I'm looking at businesses is what I'll call a scrappy cash flow projection. Like the balance sheet and income statement, to me, I have to understand them and they have to make sense. But to me, it always really hangs in that cash flow plan, right, early, because it kind of shows that the entrepreneur is really ready to go and game. Yep. And kind of his KG. Do you have sort of a general feeling when you look at a business plan, when you do kind of balance sheet, income statement, cash flow, where I guess what we're looking at here is where not to blow it right away, right? Big mistakes.
In terms of blowing credibility?
Yeah, because I mean, this is where now people, will just put an X on your business plan because you blew it in your financial plan, right?
So, I mean, I think ultimately as you talk about having those ingredients being balance sheet, income statement, and cash flow are important and critical, yes, right? But in terms of blowing credibility, when I get something that somebody sends me, what are turnoffs are people that are essentially drinking their own Kool-Aid and can't give out a model where at the least you can talk through, like, what if it's not the rosy picture you thought, right? So, there's that angle. So when you're building out your model, having the ability to either have like a low, an expected, and a high case. And honestly, if you can't make your business viable at your low case, that's a turn off for me. If I look at something and somebody's, worst case scenario, it's not viable, more often than not, investor is like, I don't want to throw my money down the toilet. I want to throw my money in an educated risk to get a return. Right. If the downside says, wow, you're going to blow your brains out, I'm not that interested. Right. So your job is to understand what that downside is and be able to articulate in that case, like, okay, how would you change things? You can't always, have that you're not always going to achieve wild success. And if you do in this path, maybe it's slower to grow, and that's not the end of the world. But at least you're able to articulate to an investor, what happens in each of those scenarios.
You're going to survive, too, right?
Yeah, or at least, and again, like because again, this comes very qualitative. Every investor that I've dealt with, they don't want people that got their head in the clouds and believing, everything's all sun and games and roses. You want somebody that when things go wrong, because things will go wrong when you're building out a business, they're capable of realizing they're going wrong sooner than later. So if you truly can, live in that worst case scenario and understand what it means and not hide from it or pretend that it's not going to happen, those become very qualitative factors, right?
Sure.
I think.
Sure. Okay. So one more thing we can talk about here. Thanks. Ratios. So obviously there are lots of ratios you can look at in your business. The one that kind of occurring to me is, and I just like, to start this part of this discussion, people are going to be looking at debt or equity financing. So they're going to be either looking at borrowing the money or getting investors who own part of the company. One of the things that when it comes to equity financing, which for many of the people who are working on these business plans, they're going to not be thinking about debt. Maybe they don't have the credit to qualify for debt, or they're not thinking that debt is an appropriate way to fund the business because they can't be sure they can make the payments. So looking at kind of more venture or angel financing or even friend and family money. One of the things that they're going to all be struggling with, and this is for me, a real challenge or turnoff, is that they make a valuation that is kind of not realistic for their business in the first instance. And so they're trying to go out and get investors in a valuation. And so, the ratio for me goes back to that whole idea of like, how do you value a new business and how is that value reflected? And so I was just thinking about kind of, should they be using discounted cash flow to do a valuation in the first instance? What is a logical way to value a new business to make it reasonably attractive to investors?
Yeah, so like when you talk about ratios, there's like two different broad classes of ratios you could talk about. We could talk about, what makes a healthy business ratios, which I'm sure you guys read in a textbook, like a current ratio, assets and liabilities. Those are probably a little less relevant, honestly, in this stage of things. What's maybe more relevant, getting towards your valuation point of view, is ratios like what's your cost to goods sold ratio? Like if you have revenues and you have direct costs, what kind of gross margin do you have? What is your sales and marketing costs versus revenues? What is the actual cost to acquire a customer? That's not a ratio. But metrics like that become very important. And then getting to your point around, raising capital and valuation, it's a dark art in startups, honestly, right? So like the technical answer is yes, you can deliver. And recently I was involved in the sale of a company where we produced, projected statements for a 5-year period, and it went off to evaluator, and they did this DCF, discounted cash flow analysis of our projections. That generates a valuation. But I mean, that's more suited to, a business that's a little more established. If you're truly running a startup, yeah, you could talk to an investor, and if they're extraordinarily sophisticated, they're going to look at your ratios, your profitability and things like that and say, oh, okay, theoretically, based on the market share that you expect to capture, there could be this much cash flow and therefore the value is this, but that's going to be one of probably many factors that drive that startup initial valuation, right? But yeah, so from that perspective.
Yeah, so that's interesting. So let's I'm going to loop back to what you started with about the ratios, that kind of the operating ratios that do matter and that, have some validity to the business plan. But just on that, to close off that valuation kind of estimation, in my experience, what happens is if you're going to go out and talk to people about equity financing that are not sophisticated investors, what they'll generally do is turn your pro formas, these pro formas we talked about, they'll turn them over to an accountant. And an accountant will take them and crank them into a machine and come back with, because accountants all have access to these business valuation tools, and they won't even care really what business it's in. They'll look at your margins and they'll look at kind of what industry it's in, and they'll slot it and they'll punch it into this spreadsheet and it'll kick out a value. So your pro formas will, if just cranked through by an accountant, lead back to a valuation. And so just be aware that that's going to happen if you give your financial pro formas to a potential investor and they take them to their accountant.
This triggers a thought, actually, that's critically important, right? Because you've given, back to my earlier point, this really rosy picture and everything else, and they put it through this valuation. And let's pretend that you actually get that for some reason, or all the challenges that they're going to challenge you on, for whatever reason you meet them all. When you later need a second round of financing, if you haven't lived up to the hype, you're going to be in a lot of hurt.
Yeah, we've seen that, right?
Totally, right? So it's just, it's a factor worth thinking about.
Yeah, and so like the first round of financing might not be your last, I think, is a key point. And so you have to be aware that if you go back out and you create this crazy high valuation, it's very hard to live up to it. And then you're giving everybody what we call a haircut on your second round of financing. More specifically, you're getting the biggest haircut because you're usually still in, the majority shareholder in the first instance. Let's go back to the ratios concept because this can also make or break your financing. There are standards in industries for ratios, right? And so oftentimes if you haven't done your homework and you don't understand what your what an acceptable gross margin in a new restaurant is, your business plan will just straight out fail for that one critical point that you didn't look and find out what was an acceptable gross margin in a restaurant.
I think it's an forgotten truth that sometimes entrepreneurs are afraid to charge, the right price. For example, so then you end up in a scenario in your restaurant example where somebody is like, they undervalue what they're doing, so then they build a whole model based on lower revenues, they take it to an investor, and the investor goes, wow, restaurant industries have all these potential problems, and you're telling us the gross margin, instead of, say, a 50% norm, is 30%. You're like, 30% is really healthy. The reality is, to your point, it's in the garbage can right away, because they're not even going to want to argue with somebody that thinks that way. So yeah, from that perspective, ratios are critical, and you should do your homework. You should talk to, whatever network you can talk to understand, okay, if I'm doing a software business, what is the normal profit margin you should target? Like, what is a normal cost to good ratio? If you were today to go say, I'm going to start up a software business and I'm going to host it all myself and buy all these servers and get a co-location space, you're going to get laughed out of the room because things like AWS exist, and the cost structures would be very different. Your ratios would be very different. So those ratios become a little bit of a key to how you run your business, right? Never mind the fact that they can also prompt you. If you look at it and you're like, wow, I can eke out 5% profit, you're like, wow, that's great. The ratio should also trigger something that says, wow, that's not really acceptable. How can I, peel back the onion and understand why it's so expensive? Why is sales and marketing 20% of revenues? And one of the things that I think about is not just ratios. It's what I call unit cost analysis, which is probably more time than we have today to talk about necessarily, but really breaking down, what it costs you to acquire a customer on a per customer basis rather than a per ratio basis.
Right.
What does it cost to service that customer? So when you go a little bit deeper, and ultimately if you're pitching truly sophisticated investors, they're going to want to understand that.
Yeah. And so it's almost like the cost per customer through the entire life cycle of that customer, and the revenue potential of that customer through the life cycle, so that you understand how many of those ultimately is break even and how many of those actually start to drive profit.
Yeah, unit cost analysis for me, I use it all the time. I'm mentoring a couple startups right now, and we use it to determine pricing. So what price should we charge? What allocations should we make? What business model is dictated based on the available revenue and gross margin? So unit cost analysis basically is, if I know I can sell something for $100, and then I'm like, the direct cost to run AWS or do this are $20. That means I have $80 in gross margin. Well, then what does it cost for me to support that customer, retain that customer? Say that's another $40. So now we're down 40 minus 80. We're down to $40 gross profit. Great, $40 gross profit. Well, how long does that customer last? What's their lifetime value? So that $40 for a month, say they last, for 100 months, that's going to be $4,000, right? So you're like, wow, $4,000. Now you have a number where you're like, okay, as a company, we need to earn a profit. And so how much of that $4,000 we want for profit, and the difference becomes essentially what's available for you to spend to acquire that customer, right? And then when you're one day talking to an investor, you can truly have an intelligent conversation, say, yeah, I've got a hypothesis it's going to last 10 years. You talk to some people in the industry, there's some validity on that, and then you can, because part of the reason why you're asking for money is I need money to do sales and marketing. Right. Now you can have a really intelligent conversation to say, I know that I can spend, my $4,000 example, maybe you want to have $2,000 of profit. I can spend $2,000 to acquire a customer. Here's how it's going to spend on marketing. Here's how it's going to be spent on sales or commission and that kind of stuff, right? So I believe in that. It's really key to a business.
Okay, so I think you've got a bunch of tips. Thanks, Brad, for coming in, and good luck with your planning. And Brad's a mentor, so you guys, if you have a really specific question and you feel like you might need some help, I'm sure Brad would be okay with receiving
Absolutely.
an email. And good luck with your financial planning, and we'll see you all soon.